Resilience is now the watchword in global markets. It's driving major shifts in economic policy as well as company strategies. It's what my good friend Henry McVey calls the security of everything. So what's behind this focus on resilience? And how is it reshaping markets and the role of the state in markets? How is it impacting the prospects for technological innovation across AI, life sciences, digital assets, and more? And can technological change in turn help drive resilience, promoting economic security? I'm Navin Girishankar, and I'm excited to be delving into these issues with Henry McVey, partner and chief investment officer of KKR's balance sheet, head of Global Macro and Asset Allocation, and CSIS Board Member. Welcome to Betting on America. Henry McVey, delighted to have you here on Betting on America. Thank you for making the time. We have really interesting perspectives on global markets, the technology revolutions that are afoot, and what that means for government policy. You approach it from a global macro lens. We do that from a policy lens. I've been excited about having this conversation because I think we might actually end up in a very similar place from these different perspectives. So thank you again.
It's great. It's great to be here. I look forward to sharing the next few minutes. There's a lot going on, so let me know where you want to jump in.
Well, let's start with your big theme. One of the big themes of research that you all have put out is what you call the security of everything. I just find that a really powerful way to capture all that's going on. I understand this, if I might just start out there, as an argument about resilience and its impact on markets and policy. Resilience to shocks, to malign threats, to various disruptions. So take us into your thesis and how it's shaping policy and markets.
Yeah, so one of the things that we saw during and after COVID is exactly what you mentioned, which is CEOs really had a different view of the world after 2020. When we would survey our portfolio companies, typically KKR owns 200 companies around the world, and the number one priority that they talked about was resiliency of supply chains. Right. They wanted to know that they could get that part, right? You had, when COVID hit, things stopped. They didn't understand the significance of having a China-only strategy or having an India-only strategy. And so what they wanted to do was to diversify, and that has led to a huge amount of spending. So some investors or some people might view that as a negative. It actually set off a pretty substantial CapEx boom around the world. And as a firm, for defensive reasons, we helped our portfolio companies create resilient supply chains so that they didn't have interruptions. But also from an offensive standpoint, as we think about private equity, infrastructure, credit, we financed growth in that in those underlying items that created that resiliency. And that could be infrastructure, that could be cyber, that could be having a new plant in a different country. It could be helping to build a competitor to the existing company that was delivering these goods or services. And then that was kind of 2020. And then you had Russia's invasion of Ukraine, which really brought that into a whole new light from a purely geopolitical standpoint. Yeah. Remember KKR, we have General David Petraeus, Ken Mellman on policy, and me, and we have kind of the three of us, and we try to think about how could the world be changing, using thought partners like you, and how do we create a better environment for our companies and for our limited partners to do well. If you look at, I'm going to use a couple of slides during our talk, yeah. But if you look at this right-hand side, look at what happened. President Trump gets elected, Russia invades Ukraine. You have a huge increase in spending in Europe. And if you think about going from less than 2% to 5%, it's not just the defense spending. It has huge implications for deficits. It has huge implications for who your partners are, all the things that you traffic in. What does it mean for technology and kind of world dominance? Those things get reflected. That's kind of that one angle. The left-hand side, what you see here is our companies. This is public data, but we we would mimic this data if we interviewed our CEOs today. They're worried about trade uncertainties. They're worried about raw materials. Can they get those? What's going on with attracting and retaining talent? And so, weaker economy because there's all these political shocks that are occurring. So you really entered a different period in terms of what's going on in the world. And that has driven our security of everything thesis. And it's been a great one for KKR to invest behind.
Yeah, that's a great way of trying to give order to what appears to be very chaotic. One of the things we've been tracking, and I'd love your thoughts on this, is what has in effect been a shift in the role of the state, I think, in markets. I think we're of a similar age. I came of age in the 90s. And what was astounding today relative to then is how different it is to think of the role of the state in productive activities. Intervention seems to be increasingly the norm. And I think this goes back, as you said, from Trump 1.0 through the Biden administration, through the current administration. And you see government involved in either industrial promotion activities through subsidies or tax cuts, sometimes equity ownership in companies, as we've seen, but also the rise of export controls and investment screening and those sorts of things. Can you help us make sense of this shift and how you see it?
Look, I think what's happened is you've had more executive orders around the world. If you think about, we've transitioned from this period of kind of benign globalization to one of great power competition. And in that world, you've got to be faster and you've got to think more with a geopolitical lens. And that's exactly what's happened with the political leaders that have come to power. So if you think, I spent a lot of time in China, a lot of time in the Middle East, and then obviously in the US. But if you think about Xi or MBS or President Trump, these are all strong leaders, and they've taken a more activist approach to economic policy, right? And so that actually started, it's been going on for some time. It's accelerated in the past couple of years. And so what's happened in a place like China is you've had a blurring in the lines between the private sector and the public sector, particularly as things such as AI become important. Right. And what's happened in China today, when we do our analysis, we think half the growth in the economy is coming from industrial automation and digitalization. That's a massive number. And if you think about that relative to where the world was, the world thought when China joined the WTO is that it would become a consumption society. Right. They've done some other things really well. They obviously have 1 billion people and they consume a lot, and that's been growing. But relative to share of the overall economy, it hasn't become the dominant force the way you see in India or the US. If you go to the Middle East, they're being really proactive around their policies there to attract capital or attract financial services. They don't want to be an exporter of capital. They want to be an importer of capital. They want to be an importer of talent and grow that economy. And certainly President Trump, you've seen that where you could use Intel as a proxy, but you've had more policy that way. Frankly, President Biden was quite aggressive around this as well when we talked about the IRA and where that money got allocated. So this is a policy that, as what we do, we traffic in making companies better. We have to be cognizant of that world that we're living in. And so it does have some implications for the capital markets and how we think about the overall cost of capital and where we operate. But I think that is very reflective of the geopolitical and economic environment, where this is a little bit of winner takes most on the economy side. You've seen this with large scale players, and certainly governments want to be supportive to make sure that their national champions actually participate as a winner takes most type of company.
Yeah. And I think one of the points that you raised there that I believe will resonate with folks in the policy community is how much continuity there has been across the different administrations over the last decade. Can I spend a minute on trade? Some people have said that we're kind of in a period of modern mercantilism, not just China, but the United States as well, and others. Give us your perspective on this, because this is an example of how the role of the state is changing. And frankly, we're in the midst of what appears to be a significant upheaval in global trade, or at least the nature of global trade over the last 8-10 months or so.
Yeah. So our view at KKR is that we are leaving this period, as I mentioned, from kind of benign globalization to one of great power competition.
Yeah.
If you look at the slide I'm pulling up here,
Yeah.
the data would support that, which is global trade actually peaked after the global financial crisis. And so what's happened, in my view, is we're going to move more towards policies where that favor the Americas, think Canada, Mexico, the United States, Europe, and then Asia. And one of the statistics that came out today is that China is now seeing a 25% increase in Asia trade since COVID, and it's lost 25% with the U.S. And you can measure this in different forms, but generally the message is intra-Asia trade is exploding. So right now, I think about 70% of trade in Europe and the U.S. is within that region, the Americas and Europe. In Asia, it's closer to 50%. But all the initiatives, back to the first question we talked about, people want resiliency. And resiliency may mean not going from just in time. It may be to going to just in case. And so that's really what you hear the private sector saying, because they're getting measured on growth, shareholder profits, and they can't have a huge long period of time where things aren't working that way. And so, I like to think about it, just keep it super simple, and I frame it here in this slide, which is you've got this blurring of the lines between economics, trade, and rule of law. And this mentions kind of where does the public sector start and end relative to the private sector. But my travels, and I go all over the world all the time, everything to Mexico, to India, to Japan, to China. A lot of the discussion gets, China, U.S. It's much broader than that. And what you're seeing is that policymakers are thinking not just about military policy or the kind of rule of law. They're thinking about their cost of capital, because ultimately with these heavy debt loads, right? Remember that debt as a percentage of GDP is up 1,000 basis points since COVID, because a lot of people had to pay for COVID. Is what's happened is they've had to outsource a lot of that to the private sector. If the private sector is paying for it, you've got to try to have your lowest cost of capital. And if your government has a lot of debt, then they're not going to have the lowest cost of capital either. So your world and my world have blurred. And I feel very fortunate to be part of CSIS as a board member, to be able to discuss things like this with you. But that is that intersection that is growing, and it's growing incredibly fast. And I think that that this blurring the lines probably will continue, particularly if we've got to build out the digital economy, and we've got to think about defense spending. We have to think about having sound infrastructure, because you're not just going cross borders. You're trying to do it within your country, build bigger domestic economies, because that makes you more palatable to absorb a shock from the outside. That's where people's policies are headed. And I think it's really a question. You see it play out in retirement savings. You see it play out in infrastructure policy, and you're seeing it increasingly playing out in something a lot about is technology policy.
Yeah, I love the heuristic you have on your slide there. It's a powerful way of capturing it. If I might, I think one of the things that we're tracking as we focus on what is an emerging American approach to economic security policy is how do you preserve the dynamism of markets while at the same time vouchsafing national security interests, particularly protecting technology advantages. And I think there's a tension there. And one of the ways in which that's playing out is a rather, I think, uncertain and volatile way in which these policy shifts are happening. We've obviously seen that with the trade agenda in the last few months. And I just wanted to get your thoughts on that, because independent of what the policy is, the unpredictable way in which it's getting implemented has its own impact on markets, doesn't it?
Yeah, I think there are a couple of things to keep in mind. If you think about it, rule of thumb, a 10% increase in tariffs is about a 1% hit to GDP, and it's about a 50 to 1% increase in inflation, right? And so what I would say is that the Trump agenda has been to lower corporate taxes, increase national security, ultimately use trade as a way to redomicile parts of the economy. And so when it came out on Liberation Day, the market went straight down. I think people have gotten a greater understanding. In my view, the Trump administration has done a couple of things quite well. One is they went and they signed deals with the closest partners, the people that own the most U.S. treasuries. Two is they have a higher base rate, but they've shifted to a lower sectorial tariff. And then the third thing is they've created trade deals that actually have these foreign entities buying more U.S. goods, which supports the dollar. If you go back to that April 2nd, the dollar went down, bond prices went down, and equities went down. That's a 5-alarm fire for most allocators of capital. So that's something that I think went straight to the top, that they started to digest into their playbook. And I would say today, most market participants, I think, really have started to absorb the tariffs. But I don't think that it's going to create the same type of market dislocation. I do think as we go to 2026, what you are going to see, and it gets back to kind of this higher resting heart rate for inflation, where if you think about, I want to just pull up one slide, this slide here. If you think about the world that we're envisioning, most of us grew up in a low growth, low inflation, tight fiscal, loose monetary policy where inflation did not hit the central bank's target. What I'm talking about is we're moving to this higher, this regime change, higher inflation, stickier inflation. You have bigger deficits, you have more geopolitics, and you have a messy energy transition. In that world, nominal GDP is actually faster. A lot of people haven't talked about that. So if you look at what's happened, nominal GDP around the world has actually been fine. The question is do you have the business model, leveraging technology? Can you create scale? Can you create pricing to deliver in that? And that's why the equity markets have kind of bifurcated into this have and have not type society. And you see this, if you can pull this slide up. If you look at the right-hand side here, look at the dramatic breakout of the margins of the S&P 100. When you compare that to the S&P 1400, it looks like part of the economy is having a recession, and then it looks like these scale leaders are leveraging technology and to dominate. And when I go to China, Chinese companies are doing a great job of this. The Indian companies are. Korea is starting to do this. And so this is where I think we used to think about competing within the U.S. or competing within China, where I think in the world that you and I are describing, you've got to be able to have that competition and that edge across all the different facets of the world to deliver value to your shareholders. And ultimately, there are political ramifications to those type of entities because they become bigger parts of the economy and they influence wealth, they influence policy, and ultimately they drive CapEx.
Yeah, such great perspectives. Just one thing I want to linger on, because you mentioned it early in that last segment. Trump administration putting up tariffs, but also tax cuts. There's a third piece as well, and I just wanted to get your thoughts on it, which is deregulation, particularly around energy and AI-related kind of initiatives. How do those three fit together? Because it's a new formulation, but it's not obvious that it's inflationary or deflationary, is it? Or how is it netting out?
So I think that when I go to Washington, what I hear consistently is lower energy costs, lower energy costs, lower energy costs. So because it's a national security item to make sure that the U.S. is competitive around AI, right? I grew up in Virginia, 25% of the power in Virginia today now goes into some form of AI or data center. So I think the Trump administration is trying to drive lower oil prices. That helps the consumer ultimately make natural gas prevalent so that it can be used and then come up with other forms of energy. So I think if you think about the model Scott Bessent is talking about, what is Scott Bessent talking about? He's talking about lower corporate taxes, increase competitiveness, run the economy a little bit hotter there, deregulate, put more power to the states, unshackle the financial services a bit. And I think then ultimately energy policy goes hand in hand with that, which is you need to have secure energy, you need to have access to energy, and then you need to have low cost energy. We just put out a piece, I was in Europe last week. I mean, when you go around the world right now, like what's happening is the Middle East and China and the US, from an industrial policy standpoint, they have a competitive advantage around lower energy costs. And in the world that we're envisioning, where data continues to drive outcomes, particularly around national security as well as industrial prowess, you need to have access to that. So I think there's going to be continued investment there. I don't think we know exactly how this all plays out, but I do think that becomes a much more important part of the equation.
Yeah, that's a great rundown and helping us make sense of where policy is landing. Let's shift to AI because you've alluded to that. I want to start with your kind of outlook around the AI revolution. Some people view it as a second industrial revolution. Others may say it's like something analogous to the PC revolution. Maybe others say it's kind of like the dot-com bubble. What's your view on this?
Okay, that's a good run of history. So a couple things I would say, and we try to be data-driven here at KKR to inform our perspectives. If you look at the left-hand side of the slide, what you see is the 1990s, you had a huge increase in revenue per employee. This is the S&P data. And then then we went flat for about 20 years. And then ultimately, we just recently had a breakout. What we see in our companies is COVID really inspired digitalization, automation, your early days of AI. And so that revenue, but I do think that's a breakout on revenue per employee. And we lined it up with ChatGPT, as you can see. What I'm most impressed by the U.S. companies is these charts here, which is when you look at the left-hand side, I've been hyper-focused on productivity. I think the analogy is that we're in the 1990s. Again, if you look at the great bull markets, the 1960s, the 1990s, what we're seeing right now, we've tried to slice and dice productivity by metropolitan area, by county, by ultimately looking at what sectors doing that. And what you see here is technology's obviously got big productivity gains. Retail trade benefited because nobody could go into a store during COVID, so they came up with more amenable features to deliver technology. Same thing across energy and oil and gas, professional services. Those areas are powering the economy, and I see this around the world, which is back to my earlier comment. These companies that are embracing technology and they're becoming scale players, typically what you see is AI is being most accepted by companies that have 250 or employees. As a firm, when we buy a company and we try to make it better, we try to have employee ownership so everybody owns that, so they're aligned to want the company to do well. We want to make sure they can get the best procurement. We also want to make sure they have the best technological prowess so that they can deliver and be competitive. And so I think that the AI, what I would say today is that we're just scratching the surface. We've got some companies that are showing some really powerful outcomes, particularly in Japan, one company in Germany, and in the US, we have a whole team that is focused on this as an initiative. But when you look at the productivity boom that's occurring to date, more of it has actually been digitalization and automation. And so that should give us some confidence that this continues. I'd say the concern is there's a heck of a lot of money going into this area, encouraged by governments around the world. It feels like to me China and the U.S. are kind of the two front leaders on this. But you're having, I think it's 5% of GDP is going into AI spend. I think the housing bubble, it was kind of 7 or 8% of GDP. Yeah. So those are big numbers. When you put it in perspective, growth in just AI CapEx by the Mag 7, just those 7 companies for the first half of the year was greater than all of the growth in personal consumption. So Navin, let's think about that for a bit. So when you think about that, those are mind-blowing numbers. And frankly, as we're adding up the 26 budgets, they're probably going to grow another 30% per year. Yeah. And this isn't, in my view, this isn't 2001 where the companies are doing the telco, CLEX, if you build it, they'll come. If you look at Meta and you look at Google and you look at Microsoft, these companies generate a lot of cash from their cloud business. And so this is an add-on. I think there'll be overspending. That's always what happens when you have an industrial revolution. And there's going to be some stories we wish we didn't hear. But I think the trend is here. And I think the big thing from my world, and I'll ask you what you think, but from my world, right now, all the values are accreting to the enablers of AI. So it's going to the utility companies, the grid, the industrial companies, and the technology companies. Over time, what we've seen, and I'll go back to the 1800s with light, is that shifted, costs went down, and then all of a sudden the people that had the application of light, or in this case AI, those companies start to really accrue the value, and I think that will be kind of AI 2.0. But I don't think we're there yet. Love to get your thoughts on whether you think we're on the right course as we think about it.
I think that's really, really well put. We see it very similarly. It remains to be seen how AI applications flow through different sectors. I think you've given us a window into what this could be. I am focused very much on the compute side and the AI infrastructure side. And you've mentioned that as well. And I actually wanted to talk to you a little bit more about that, because if you think about, we've been doing some work on different scenarios around that. If you look at the binding constraints, you talk about technology enablers. We view energy as one of them. I'd like your thoughts on that. You've talked about that. And let's go a little bit further into that. The other big one is labor. And I know you've been working on that as well. And I think that what's interesting is that investments in those two enablers have spillovers beyond AI. They have spillovers into other sectors, into chips, and into potentially in life sciences and other aspects of the U.S. reindustrialization agenda. But maybe let's take them each one by one and start with energy and then start with labor to get your perspectives.
Look, I think that, the Wall Street Journal and others like to report on NVIDIA, the chips, because that's the, that's the most interesting part of the story. What we're seeing, though, after 20 years of flat demand for electricity, it's starting to go up substantially. And that is not only a U.S. phenomenon, it's a European phenomenon, certainly in China and the Middle East. So the grid is old, and the grid is not set up. Go back to that word I use, resiliency. If you were building out data centers and others, you would want more resiliency than what we have right now. You can use Texas as a proxy where the power has come on and off. If you think about parts of renewables, do you really want when the wind blows that it works and it doesn't? That's not going to work. And so what we're going to have is, I think we're going to have a massive rebuild and upgrade of our internal infrastructure in the United States. And I think other leading tech franchises around the world are gonna do that. So that is an exciting area for investment. It's going to take, back to my point, which is leaders are gonna have to be aggressive around really moving things through the Congress. They may have to do more executive orders, but the current state of affairs, I mean, that's where an area like Europe, they're going to have to decide, how are they going to move as a 27-state nation to make that work. I think the U.S. and others have some advantage there, but you do have pushback at the state level in certain areas. So this will be a big topic of debate. The second point that I believe strongly about this, and maybe it's a moral compass or whatever, but this whole change in technology, we have a responsibility as a society and as a government to make sure we're reinvesting in our people. And if you pull up this slide right here, what you see is the U.S., when you think about the amount of money that our government spends on public retraining, it's a fraction of what you see in other parts of the world, and it's frankly a fraction of what we think is necessary. So as a firm, we've been investing aggressively behind companies that do worker retraining. When wages go up and things change quickly, companies do a couple things. One is they're more apt to lay people off, but they also invest aggressively in technology to make sure they stay competitive. So, but you can't just invest in the technology and not invest in the human part of it. And so otherwise you'll get atrophy of skills, right? And so a major focus on what we're trying to do is drive, one, employee ownership so that employees feel like they're part of the solution. And two is then at the worker level, you've got to arm them with the skills for the next generation on where we're going. And AI is certainly a big part of that, but this is not just an AI story. I mean, there's more you can do around, there are lots of jobs right now. We've got a skills mismatch on what you need. Some of this will be, in my view, greater investment in vocational schools. I know that's an important part of this administration's thought process. I think generally that should be something that the U.S. invests behind as aggressively as it does than just four-year colleges. But that's the way of the world, right? I mean, when you think about it, a lot of the skills as we reshore, we're certainly going to need the high-end R&D, but we're also going to need the basic blocking and tackling around how do you do, welding? How do you think about critical minerals? And how do you think about, turbocharged agriculture? So there are things that America has done well in the past that with the right amount, with the right policy and the right investment behind that and the right incentives, because ultimately the way these things win over time is the government sets the table, but the private sector is the one that sits down and has the meal. And we got to create more opportunities where that can be this public-private transfer is taking place. And I think we've done a great job on the employee ownership. This is really a renewed area of focus for us at KKR, is to get behind the worker retraining, do that in the private sector, but we're going to need some public sector support to achieve our goals.
Music to my ears. Oh my God, you said it so well, and I love the data you're bringing to this. If I could throw something your way, when we did our modeling on the AI infrastructure build out, we looked at the high case, like if this were a second industrial revolution, what would you need? And the conclusion is that not since World War II has the demand for skilled trade labor in the United States converged so clearly with national security. And if we looked at the numbers for the things that you mentioned, welders, construction workers, HVAC operators, heavy machinery operators, we will need something like 140,000 more of these people between now and 2030. Those were just our numbers, our estimates in the high case. And guess what? We don't have enough apprenticeship seats to actually do that. We need something like a 50% increase in apprenticeship seats. And that's like a public sector, but that's a private sector solution that's needed. So I just want to really foot stomp what you've just said. And I think it's an area for us to maybe talk more about. This is hugely interesting what you're doing.
Yeah, and I think if you take it a step further, it's not, we talked about welders, but also around transportation and logistics. I mean, the government shut down. We're short controllers. There's a lot going on around that transportation sector where we're also trying to make a difference. I'll pull back up this one slide, but when you look at where you're getting productivity, you're not seeing it in non-durable goods. You're not seeing productivity in construction and parts of utilities. Those are critical underpinnings of the U.S. economy. So it doesn't work just to have all your productivity in the IT sector and not have it be more broad balanced. So I think that's an area for both CSIS, KKR, and others to kind of lock arms and invest more behind.
Absolutely. I mean, I just want to linger on something for a moment, which is it's this convergence of what makes sense from an investor's perspective and what makes sense from a national interest perspective. And to see moments where those things converge is really quite encouraging and really inspiring. And so, thanks for sharing what you all are doing. You're a global investor. You've spent a lot of time around the world, as you were saying, and I through this conversation, you've highlighted places where you've been, but let's just spend a moment on that, because I think when we were talking about doing this, you happened to be in Europe. So tell us what your travels have been sort of illustrating for you and for people who read your work.
Okay. So, we put out these from time to time, kind of thoughts from the road. I was all over Europe. Look, the title of the piece for Europe was Carpe Diem, and it gets back to a little bit, which is there's such opportunity in Europe. We're having a very busy investment time, but we need faster government change. And I would highlight kind of two areas. One would be around the securitization market. They've got to create greater capital flows across the region, and they've got to create deeper markets, particularly on the fixed income side. So that would be something that I would be pounding the table on. Second is, look, most of the developed markets, if you look at what's in Europe, the periphery is massively outperforming the core, which is very different than when I joined. So when you think about the UK, France, those big stalwarts, they need to get their debt under control, and they need to balance taxes with innovation. The word entrepreneur is a French word, but you don't always feel that when you're sitting in Paris thinking about what's going on. So those would be two areas to me, is like striking the right balance between taxes as well as the where you're going to spend that money, and then kind of leading to better private sector outcomes. And the second one is I'm very focused on capital markets. I think the Draghi report was excellent. I think he had 400 suggestions. I think 40 have been implemented. If I pin you to Asia, move to Asia quickly. Japan, I love what they're doing on the corporate reform story. It started with Abenomics. Under almost every prime minister, that has continued to be a huge change, that it's going from deflation to inflation. It feels like to me that Korea just found Japan's playbook. They're starting to implement reforms. The markets are responding. There's obviously been a lot of political instability, but that's a great opportunity. India, huge consumption upgrade, particularly the middle to upper class. That's a really interesting story. They're benefiting from what's kind of the China plus one area. I'd say on China, look, it feels a lot like it did in the U.S. after 2007. When you have deleveraging and you have a housing problem, which is what China did, it takes really extreme policy, and the government's starting to do that. I would probably argue real rates need to come down a little bit, and I think they need to inspire. The savings rate's gone up a lot. They need to inspire more savings, more spending, and bring that savings back down to a more reasonable level. And then ultimately, I would just say for whoever's listening to this podcast, don't underestimate the competition that's taking place right now in China from the automation and the digitalization of the industrial sector. I mentioned that it's over half their growth right now. I think global giants are going to China to learn how to play, and then they're exporting that globally, or at least that technology. And sometimes it's affecting prices. And ultimately, it probably will tie into this world where we have, this modern day stagflation, where we have input costs going up from tariffs and shortage of labor in key sectors around the world, but at the same time we've got the ability for certain countries to export in a little more of a deflationary bent. So for what I do, I've been doing it for a while. It's one of the most fascinating times out there.
Yeah.
You could take your ball and go home. I think what we've touched on here is there are a lot of important investment themes: security of everything, productivity, owning infrastructure. There are lots of things that you can do in this market. And I think as long as this productivity cycle continues, markets are going to continue to chug forward. I don't think it's going to be quite as robust as it has been, but I'm very focused on the success that productivity brings to the corporate sector and obviously to the public sector. So that's where, if that slowed down, I'd change my view, but that's not what I see right now. Powerful
perspective. We've talked about the real economy, both here and abroad, and through your travels. Let's just shift for a second to the financial sector. I'm very interested in where innovation and national security meet, and there's a lot of ferment around stable coins in the policy world today. Not only with the Genius Act, but the Clarity Act. And I just wanted to get your view on stable coin as a financial innovation and what that means, not only for the dollar, but also importantly, just as a sector. Any thoughts on that? So my background pre-macro was financial services. I'm not an expert. I'm sure there's somebody that knows more about stablecoin, but let's start with the premise that financial services for decades was predicated on centralization of information and transactions, and that allowed it to be regulated quite well. What we're seeing with crypto and other new forms of financial services technology is this move towards decentralization. That's what the blockchain really unfolds. Right. On stablecoin in general, I think it's a very smart move by the Trump administration. We've got competing currencies. If you're China or Russia after Russia-Ukraine or anybody, you'd say, hey, I'm not sure I want to be on SWIFT. What about SWIFT? And what about, do I want to be beholden to dollars? Right. So you're getting an external and international reaction to that, that policy in the United States. What stablecoin does, I mean, it's hundreds of billions right now, but it's forecasted to be a lot bigger, is it actually brings that, it allows people a vehicle to still be dollar-based, right, but have some adoption of modern technology. So I think it's a pretty creative outcome. I think this market will continue to grow, but I think it's a lot more than just about the Genius Act. These are national security policies. These are ultimately capital markets policies, right, where you're getting this blurring of lines. And I think most countries are going to adapt. Whereas before, policy was always around, let's come back to centralization because that's the easiest way to contain things. Right. And what you're seeing as the intensification of geopolitics goes up, and you have this rapid increase in technological change in the financial services system, I think things like stablecoin become a vehicle for expressing that change. And so net, I think it continues to grow. It's not a perfect technology, but I think that it will continue to be something that expands in that market. Absolutely. And one story that, or at least one thread of this story that we've been paying attention to, is that some people would say that China's played the long game in terms of CBDCs and trying to develop the new platform for the future relative to SWIFT. And, this is an opportunity for the US and USD-based stablecoin to extend our capabilities in that area as well. But it's an interesting debate to be had.
Yeah, I mean, I kind of look, I mean, if I go to China, you can log on to Baidu, I can go to the US and I can log on to Google.
Yeah.
I think sometimes people think the world's going to end because it's got to be one or the other. I think given the technological prowess of both these superpowers, there'll be alternatives. It's what we've kind of mentioned this earlier. I like this term, winner takes most. That's probably where we're going to be.
Yeah.
Financial services, if you think about what is financial services at the end of the day, it's a scale technology and cost business, cost effectiveness business, putting some type of intellectual capital on top of that.
Right.
And you're going to see those firms that create scale in those areas do well. And I think that's going to be fascinating. I mean, one of the things, it's great to have this conversation with you. I mean, there's so much that we know, and then there's so much that has changed that we've been able to adapt to. But anybody who gets on this podcast and says they know exactly where we're going, it's too much hubris. I mean, we're learning along the way. I think it's really important for your listeners to continue to dial into what CSIS is saying, what we're saying, and then use that as a flywheel to get better, because nobody's got all the answers right now. I don't care where you live, what industry you are. The pace of change in my 35 years in this industry has never been faster, and that's an incredible thing to say from an opportunity standpoint. But you've got to continue to stress your thesis and test it to make sure what you believe holds. And the opportunity set is to actually have that long-term focus and then shift your framework, but not lunge too much to the left or too much to the right. And I think the way you presented your work, which we read pretty actively, is a balanced view, and it's got direction on where we're going long term. And obviously you'll make adjustments along the way, and I will too. But I think that's what we need more people doing versus lunging one way to the left or the right just based on some near-term reaction where they may not have all the information to start.
Can't say that better. That's really great. And in fact, you've said this as an investor. You guys are you live or die day to day based on the power of your ideas in markets. I learned that when I was at Bridgewater. That humility, I think, is needed in the policy community as well. And there's a tendency sometimes to over-index on certain theses. And I think that that's kind of my desire in trying to benefit from your insights and folks in the investment community and have them really be part of these conversations in the policy world, because we can stand to benefit hugely, particularly where technology, national security, and markets intersect. And so with that, I really appreciated your time, the incredible insights and perspectives that you've shared. Henry, I hope this is the first of many conversations like this.
Great. Well, I really appreciate it. This is only my second podcast in my life, so hopefully it's well received, and we'll see where it goes. But appreciate the opportunity, and thank you so much.
Amazing. Thank you for listening to today's conversation with Henry McVey. You can find this episode and more on CSIS.org, YouTube, or wherever you get your podcasts. This is Navin Girishankar reminding you that everyone has a role to play in winning the tech race.